All right. Good afternoon, everyone. My name is Attorney Joanne DiPietro. I have been a practicing attorney in this area for 22 years now. Oh my gosh. My office is right down on Main Street in Walpole. And for a majority of those 22 years, I have been in the Walpole area. Thank you so much for joining us today. The topic that we have today is with respect to Mass Health eligibility and the transfer rules. I cannot stress enough that this is not a kitchen table conversation. This is a conversation that you need to have with someone who is educated and has experience in this field. It's like when we talk about estate planning, how everyone's estate is different. You know, I love when somebody says, I just need a simple will, and then we start talking and it gets into more and more. Medicaid, also known as Mass Health in Massachusetts, and those transfer rules are very specific. And quite honestly, it's very easy to think it's one way, but it really should be another. And then by the time you get to Mass Health for eligibility, it doesn't work. Okay, so that's a very broad disclosure statement, I guess I'm saying to you, that I need you to make sure that you understand what we're talking about, to the effect that you know what questions to ask. Everyone's going to have questions on this one. I still have questions, honestly, because there are always Mass Health appeals. Just like in the regular court, how does our law come about? It comes about because people either commit a crime or there's an appeal about something, then there's case law, and then there's statutory law. And Mass Health eligibility rules are changing, ever changing. Okay, so just pay attention to that. And just so that you know, May is National Elder Month. So that's across the country. The brochure that I gave you is from NALA, which is the Academy for Elder Law Attorneys. I'm a member of Mass NALA. And that's where I get a lot of my information. And you read the newspaper every day to get the information on what's going on in the world every day. That's where I learn about new case law and things that are going on. So that brochure will give you some information, general information, but it will also tell you where you can find other information that you may be looking for. So, like I said, I gave you a little cheat sheet, which gives you some information here. That Mass Health is a joint federal-state program that pays for nursing home care for individuals who meet certain financial eligibility and clinical rules. Okay? So you have to qualify in order to receive Mass Health services. How are you? Welcome. So for many people, when we talk about estate planning, thinking about going to a skilled nursing center is rather unpleasant. Not only unpleasant because you've had to leave your home, but also because of all that money that you've accumulated from working so hard for all of those years are going to be used by the nursing home. Skilled nursing care, 24-hour skilled nursing care is what we were talking about. When you go into a 24-hour skilled nursing care facility, you're a private pay patient once you walk through that door. You sign a contract to get services from them. There's like a menu of different types of services you can get, but if it's 24-hour nursing care, that's what we're talking about when we're talking about Mass Health eligibility. So you're a private pay patient first. They pick your pockets, right? Healthcare, skilled nursing care right now is estimated at $15,000 a month. Okay? So unless you have pre-planned, which you can do, you can pre-plan by purchasing a policy for long-term health care insurance. Okay? A lot of my clients actually have it, especially ones that worked for Raytheon and, different big companies like that, because it was an incentive, one of your, bonuses or whatever you want to call it, when you were an employee for these particular companies. back in the day, when they were first issued, the premium was palatable. The company would pay for it, and then it would pass off to the individual when they retired. Today, long-term health care insurance has a high, hefty premium to it. And just like any insurance, if you have a pre-existing condition, it's not going to be covered. So just like any insurance, we don't know if we're going to use it, okay? But that is one way that you can plan to pay for your health care, is by purchasing the long-term health care insurance. So the cost of home care in Massachusetts, nursing home care, is about $140,000 to $190,000 per year, with a daily rate of $400. You can get a pretty good hotel room for $400 a night. So the premiums to purchase the long care are usually above a middle-class person's means right now. When you're considering your homeowner's insurance, your real estate taxes, cost of living. I bought a bag of cherries last night at the supermarket, and it was $17. I almost fell off my cart. It's expensive right now, especially we have a lot of ramifications from the COVID-19 pandemic that has increased prices across the board. So the Medicare program will help you, and Medicare and Mass Health are interchangeable. Medicare is the federal word, Mass Health is the Massachusetts word for the eligibility portion. Help you pay for medical expenses within the long-term skilled nursing centers, but not non-skilled. So for instance, if you decide you're going to go to an assisted living facility, it's not covered, okay? It has to be skilled nursing in order to qualify. So how do you qualify? You need to meet two aspects, and this is on the little cheat sheet that I gave you. An applicant's financial eligibility looks at the individual's income and their assets. So the income, all the money that the applicant receives, such as Social Security, dividends, pensions, rental income, all of that money will be going directly to the skilled nursing center, with a caveat. There's caveats to everything on this. Then the assets, anything that the applicant owns, cash, mutual funds, automobile, real estate, all of this is looked at with respect to your eligibility. What does eligibility mean? Hi, Mass Health, I'm in a 24-hour nursing care center, and I would like you to pay for it for me. You have to become eligible. So the applicant's financial eligibility and income and assets are taken into consideration. Now, income limitations. There's no income thresholds, okay, for nursing home residents, so long as they don't exceed the private pay rate at a nursing home, okay? So this goes into when you first go into a nursing home, that you have to ask the questions about the cost and things like that. The resident contributes all of their income towards the monthly costs, minus certain allowed deductions, which are called personal needs allowances. So right now, they'll look at your income that's coming in, and they'll take $72.80 out of that, and it goes into a personal needs account at the nursing home. Pardon me?
The $72 is per what?
Personal, that's per person per month.
Per month?
Yep. And that can be utilized for getting your hair done, whatever it might be, something like that, a personal needs account. So that $72.80 stays in your pocket. So if there is a non-applicant spouse, so you have a spouse that's living at home and they are healthy, there's different variations that we're looking at. And you've probably heard of all these certain things that can happen. You can purchase annuity. I'm not going to get too deep into the annuities because they're complicated. They're very case specific to the particular person. But if the income falls below a certain minimum, this community spouse will then be allowed to keep a portion of the spouse that's in the nursing home their income. Okay? So, summary, your income goes to the nursing home unless there's a rule that we can pull it back and give it to the community spouse, which is the healthy spouse at home. There's also a minimum monthly maintenance needs allowance. Okay, so Mass Health rules provide that a community spouse needs income equivalent to 150% of the federal poverty level, which in 2021 accounts to $2,155. That means any of your income that comes in, you're the spouse that's going to the nursing home, can stay with the community spouse, the spouse that is still home, $2,155. So I don't know about you guys, but that won't pay my real estate taxes in Walpole. So as you can see, there's a lot to look at with it. So let's talk about assets. 3 types of assets when we're looking at this particular issue. Non-countable assets, inaccessible assets, and countable assets. Okay, so in order to become eligible for services to have them pay for your skilled nursing care, the Mass Health imposes a $2,000 asset limit. You can only have $2,000 in a checking or savings account. For monetary, you can also have $1,500 in what's called a burial account. So in that situation, your income would go straight to the nursing home, and then that's the money that you can keep, and you need to have spent down, which we'll talk about that in a little bit, in order to reach those thresholds, okay? So a lot of people, you know, when I sit down with them for estate planning, and some of you have been tortured by my estate planning questionnaire, when we go through everything that you own, you can really see that the percentages of people that will actually become eligible for nursing home care paid by Mass Health is actually low unless you do some sophisticated planning. And that is dependent upon everyone's individual circumstances, but also that planning, I always say to my clients, there's a pro and a con. Great that you've got the planning working, but we don't have a crystal ball to know whether or not you'll really end up in a 24-hour nursing care facility. And we don't know how long, if you do go there, how long you'll be there for. Okay? So again, it's an excellent planning technique, the different tactics that you can use to shelter your funds, but again, it's very personal. So when we look at those asset limitations, the other accountability that we want to talk about is that community spouse that's home. They get to keep $130,380 of the countable assets. All right? Let's talk about what's non-countable, because that's actually an easier way to explain what is countable. So if you have a principal residence in Massachusetts, and this is probably what most of you have heard about, moving your home into an irrevocable trust, right? Let's talk about trust for 2 seconds. Trusts have 2 components to it. You have the legal name that's on record at the Registry of Deeds, okay? Then you have the equitable interest of the property. Sometimes it's the same person, sometimes it's not. In an irrevocable trust, you would take your home that you have today and you would convey it over to an irrevocable trust who the trustee is a third party. They have no interest in your property right now, so you can't convey it over to yourself because you have to lose what's called dominion and control. If you have dominion and control over your asset, then guess what? It's yours, and it can be a countable asset. You know the adage, you can't have your cake and eat it too. You can't say, I'm going to keep my house that's worth $450,000, but I'm not going to let any creditors touch it. You can't do that. If you want to take the house and shelter it from creditors, it needs to be moved over into an irrevocable trust. You have a different person as the trustee. Most common with my clients, it's a child or an advisor of some sort. And then we have to get through that look back period. Everybody's heard those words before. The look back period is 5 years or 60 months. Okay? Again, it's an estate planning technique that you can take your home and move it over into an irrevocable trust. But if you go to if you go into a nursing home and you're trying to become eligible within that 5-year period, it's going to be pulled back into as a countable asset. Once you get through the 5-year look-back period, it's a non-countable asset. Okay? Any questions? And I should have said it when I started. You know I can talk about this stuff for a while. If anybody has questions, please let me know. You can interrupt me. So that's the difference between countable and non-countable. So when we're thinking about moving our primary principal residence into an irrevocable trust, there's pros and cons to everything. The pros are that eventually in 5 years, it won't be a countable asset in the event you need to become eligible for Mass Health Services. Some of the cons can line up as you bought your house in 1968 for $50,000. Now it's worth $450,000. When you deed it over to that irrevocable trust, you're deeding it over for nominal consideration, which means not fair market value. So you're really gifting it over, which we can give gifts under the federal law. This year it's like $11.58 million. You can gift up to that much money during your lifetime without incurring a gift tax. Okay, we've gotten past the gift tax. But what happens is your irrevocable trust more than likely will follow the same scheme as the rest of your estate planning documents. Scheme as in what I mean is your distribution to your heirs, okay? Those heirs, when they go to sell the property after your death, most likely, they don't get the step up in basis. So let me back up for 2 seconds. If I die today, my house would get a step up in basis. I haven't owned it since 1968, but in the past few years, the value has increased. As we all know, real estate's going high. So my children would get the step up in basis, meaning when they go to sell it, there won't be a capital gains tax. If you take your house that you bought in 1968 for $50,000 and now it's worth $450,000, you move it into an irrevocable trust. When your kids go to sell it, their basis is $50,000. So let's say when they go to sell it, it's worth $600,000. They don't get the step up from your death. Okay, so there's a capital gains tax there. Is it worth it? The capital gains tax may be much less than the value of the services that you got from Mass Health at $15,000 a month. So we have to weigh everything to see what's best. Okay, so the house again can be countable or it could be non-countable. It can also be non-countable if you tell Mass Health Services that you have an intent to go back. An intent to go back, okay? You know, you could have been in a bad accident or something, and you went from a rehab facility, they rehabbed you up and said, okay, you just got to go somewhere so somebody can watch you for a little bit for 24 hours a day. Great. If you know that you're going to go back to your principal residence, it's a non-countable asset. A house is also a non-countable asset if you have a child that has been living with you for at least 2 years, and because that child was living with you for 2 years, you didn't have to go to the skilled nursing center yet, okay? But when they live with you, they actually have to live with you. They have to show that as their primary residence, like on their tax returns and their driver's license and stuff. Everything's got a little thing here that you gotta make sure you read between the lines on everything. The other way that it could be a non-countable asset is if you have a disabled or a blind child of any age, or if you have a sibling that has an interest in that property, an equity interest, and they've lived there for at least 1 year. If the applicant checks the box indicating that they do not intend to return home, the home becomes a countable asset and must be put on the market for sale. So a hypothetical would be, they've picked your pocket, you've gone through your assets to pay for your health care. The last asset left is the house. Is it countable? Is it non-countable? You're a single individual. You don't have that healthy spouse at home. You don't have one of those other reasons to make it non-countable. At that point, if you don't produce the funds on a monthly basis to pay for your care, you'll be required to sell your home. Okay, so when people hear say, oh, they're going to take my home, It's basically that you have to sell your home, get the proceeds to pay for your care. Okay? Any questions on that? No? All right, so let's talk about inaccessible assets. So you may have assets that are inaccessible to you. So those won't be included in the calculation of your assets with respect to your application. So let's say it's an expected inheritance. While people are still alive, they can spend all their money. But if you know that your great aunt Gertrude is going to be giving you money, that is inaccessible, okay? Because Gertrude can still sell it during her lifetime. And that's before her probate's completed, because we need Gertrude's probate to prove whether or not there's an inheritance there. An inaccessible asset is also divorce assets prior to a final decree, okay? The other type of asset, which we talked about a little bit with the house, is the countable assets. So all assets not considered non-countable or inaccessible are considered as countable. So that means they're counted towards the $2,000 or the community spouse's $130,380 limit. So after you look at those countable assets, that's when we start to talk about spending down. Okay? Now, as a caveat, if you have jointly held assets with your spouse or anyone else, there is a presumption that the funds held in those accounts belong to the applicant. Because when you're a joint owner on a bank account or a checking account, whatever it might be, both people can go in there and pull out of it. So you still have, even though it's joint, it's like an undivided amount. So I might take 75% and only leave 25% for that other person. So joint accounts are includable as an asset, unless you can demonstrate that the non-applicant joint owner contributed part or all of the funds. Okay? So let's go back to, I don't know, estate planning 101. What we do is we put our children on our checking accounts to make it convenience. For convenience only. That's called a Taunton trust. My daughter didn't contribute any of the funds that are in my account, so all of those are countable for me. Hypothetical B is my daughter and I have a college account for her. Maybe we'll just call it college spending money, because I don't know if we'd have that much money in there for college. But we have a joint account together where I put $20 in a week and she puts $20 in a week. Okay, and that's proving then that she was adding to it. So only the funds that I put in it would be a countable asset. Okay, so that's the difference between joint accounts. Trusts. We started to talk about trusts for a little bit. Mass health appeal decisions. There's a lot of decisions going around right now about not the irrevocable trusts, but revocable trusts. An estate planning technique. When we have a husband and a wife, we create a trust that, in a vacuum, separates the funds that the husband and wife own, or spouses own. And the reason why we do this is because one of the parts of estate planning, one of the roads that we travel, is trying to minimize the estate tax consequence on the second to die. Between a spouse and a spouse, when the first spouse dies, there's no estate tax. So you know that's the adage, you pay taxes when you're alive, income tax, you pay taxes when you're dead, estate taxes. There's two different types of estate taxes. There's federal and there's Massachusetts. Massachusetts used to piggyback the federal. Now Massachusetts has a statutory law that when you die, if the snapshot in time shows that you have $1 million and more of assets, you're going to pay an estate tax, okay? But those types of trusts that we use, those are revocable trusts, the marital AB trust. Again, as opposed to that irrevocable hypothetical we were talking about with the house. So right now in Mass Health, there's a question as to whether moving property to a revocable trust can protect it. Mass Health has been infamous to say if you have dominion and control over whatever is in that trust, then it's a countable asset. Okay. So I'm not going to speak any more on that because it hasn't been fully resolved as of right now. But at this time, the best protection for your home is an irrevocable trust. Get past the 5-year look back period. Going back to eligibility, community spouse resource allowance. When a nursing home spouse has a spouse at home, the community spouse, the resource rules are a little bit more complex, meaning there's an allowance that goes to. So in addition to the $130,000 and the other money, the $2,000 on a monthly basis, there's other money that can go to the community spouse. This is on a case-by-case basis. It definitely depends on different circumstances. So let's go back to spend down. I told you that we'd talk about spend down. So once we've determined your assets, the countable, the non-countable, and the inaccessible, let's use easy math. Somebody that I know has $150,000. They've already prepaid their funeral expenses. They've already prepaid grandchildren's college education. They've already spent a good amount of money in an appropriate manner, which means that they're not trying to avoid a creditor. So there's rules. And they've done it all appropriately. And now we have a bucket of $150,000. We've got to get them down to $2,000 or show Mass Health that this is when they'll be down to $2,000. So they've already entered a 24-hour skilled nursing facility at $15,000 a month. So pretty much right there. We've got 10 months of paying in order to spend down to get to the $2,000. Okay? So you can file the Mass Health application, a little bit ahead of time, and you can show what's going to happen in the next 10 months in order to get them eligible. Now, becoming eligible, using the application it's like another part-time job. You have to find all your financial information for the past 5 years, just like the house. Everything has a 5-year look-back period. Gifting, whatever it might be. If you've gifted money, again, for a non-countable reason, a countable reason if you had to put an addition on your daughter's home because you sold yours and the addition was all handicapped, you needed a certain bathroom, that's fine. But if you gave her $200,000 so that she could put the 3rd floor on her house, that's not going to work. So they're going to look at your statements for 5 years to see where all of your money went. Okay, so you have to be very detailed orientated. And a lot of times when people obviously are going into a skilled nursing center, they don't have the capability of going to the bank and doing all these kinds of things. So like I said, let's go back to estate planning 101. Make sure you have those durable power of attorneys effective and active and recent. Even though it's durable, the word durable says that it lasts after you lose upstairs, after you lose capacity, and it should be solid. There's been fraud and other things going on. So some financial institutions may question a durable power of attorney that's 10 years old because there could have been another one already written. So that's why I say to you, and it's not like I'm trying to make money, but I ask you to please update it if it's more than 5 years old, your durable power of attorney, because we don't want to have your attorney back down the road have a problem with getting all of those statements and everything from the bank and your investment advisor and things like that. Okay? Yes?
I have a question pertaining to getting down to the $2,000 limit.
Yes.
How come with everything else that's been inflated, how come they haven't lifted that restriction?
That's a very good question, Linda. Thank you. So Linda's question was considering inflation that's going on with houses and food, and the biggest one is building materials right now. That's causing a problem with some of my clients that were building new homes, and now all of a sudden the contractor wants another $30,000 from them. Linda's question was, How come Mass Health isn't raising the amount? I don't know. That's a good question. I would tend to say, I was just going to say, it's a government question. Exactly. Exactly. And you know how that works. Lobbyists get things done. So we need people to lobby to show that, $2,000 isn't really, yeah. Okay. We talked about transfer rules. Of course.
The assets, the mutual fund. On the mutual funds, does that include the 401k funds?
No. No.
Good.
It's to a certain dollar amount though. So it does need to, you need to sit down with somebody that specializes in it, the application. Because if you have a community spouse at home, there's a way to create an annuity out of that 401k funds so that you can shelter it. Let's see here.
There's also a discount if you're a veteran.
I don't know. A discount in a 24-hour skilled nursing center? Is that what you mean? I mean, if you get VA services through the VA, yes. Yes, if you're a veteran and you go for services through the VA, I know that definitely. Through a private skilled nursing center, I'm not sure. Yes.
The biggest issue is, are there facilities that take Mass Health?
Yes, they are. They're not allowed to discriminate.
So all facilities must take Mass Health?
So we also have, they do have, there's a certain number, I'm not quite certain what that is, of percentage of beds according to each facility. But what's also important to take into consideration is that the elder generation are growing. People are living longer, which is part of the reason why skilled nursing is going up in price too, because there's more people to care for. And these facilities, as you can see, are being built in a...
So if you're a payee to begin with,
Yes.
and then you bring down your assets so you're eligible for Mass Health.
Yes.
So you're a payee to start, and then you bring down your assets, and now you're eligible for Mass Health. I don't want my mother to have to move homes. That point is, is she automatically allowed to be one of the?
Yes. Yes.
Yes.
The nursing home. So like I said, when you sign a contract for someone to stay there, it's almost like you're a tenant at will. You pay in the first of the month, you get to stay there for the remainder of the year, the remainder of the month. If they're receiving funds from Mass Health to pay that, yes, you can continue to reside there.
Okay, but what if you start as a payee and then you pay down, so now you're eligible for Mass Health?
Right, and that's usually the circumstance.
Okay.
More than likely, that's usually the circumstance, that you go in as a private pay patient and then you become Mass Health eligible, and then they Mass Health to receive the payment for the care.
Excellent, thank you.
Yes, yes,
They have to accept you as Mass Health at that point?
yes, yes, if they have beds.
Right, but if you're already in a bed.
Yeah. So at each facility, there's always a social worker or someone to that effect that works with people on filing and becoming Mass Health eligible. As a side note, let me just say that in addition to elder attorneys, like I gave you the information about NALA, there's also some services out there that are available for flat fee rates for people that don't have, high wealth, and that they just need someone to help them with the application. There are services out there. Okay? Anything else along that line? So part of that spend down is also about gifts, and we talked about this too, about putting an addition on for you or putting an addition on for someone else. So Mass Health considers transfers for less than fair market value to be disqualifying, which is why when you gift that house to a trust for nominal consideration, it's disqualified. So if it's a disqualifying asset, it could result in a penalty period. Okay, so this is why the timeline of filing is very important as well. So gifts made for the purpose of paying a child's tuition, grandchild's tuition, wedding plans, a down payment on a child's home may be viewed as disqualifying, which is helpful for the spend down process. So let's talk about, are there any questions up to that point? Anything? So I just want to gloss over a little bit on estate recovery. So if someone was in a 24-hour nursing facility for a period of time, the state has the right to go after the estate, the probate administration, in the event they haven't been paid for the funds that they've given out. Meaning, if within the estate they actually had assets, the state can file a lien in the probate docket at the probate court for the county to get an estate recovery. They will also file a lien at the appropriate registry of deeds in the county that the property lies in. Recovery is limited under current law to collecting from the recipient's probate asset. In the case of the recipient's home, can only be pursued if there's no surviving spouse, a child under 18, or a disabled child of any age. Again, that mirrors the non-countable asset rule. So if there's a surviving spouse at home, that lien would actually go away upon the nursing home spouse's, for the nursing home spouse's debt. Okay, so that would go away if there's a healthy spouse at home. So I just want to reiterate again that planning is key. Planning is key for that 60-month look-back rule, 5 years. So again, we don't know when something could happen. It's always good to have the foundational documents of your estate plan set up and ready to go. And then you can do certain techniques in the event you do enter a nursing home, you do unfortunately have a new diagnosis or something like that. And then you can take your current estate plan and configure it to the way that you need to in order to meet your goals. Are there any other? I know I threw a lot at you. No? Yes.
Just on a side note, I had a relative that was living in the family home, and she actually became unable to be in that home any longer. And when she subsequently passed away,
Yes.
and we had to settle, my parents were still
Estate.
alive, so that was when we had to settle the estate.
Uh-huh.
Because she was on mass health, once the estate was settled and her portion was allotted, she had to give it to the, we had to give it to the nursing home.
Yes, that's correct. There was no way to shelter those funds at that point. Yeah. Yep. All right, well, thank you very much to all of you for listening to me today. You're very welcome. Thank you for coming. And if you have any questions, you know how to find me. Thank you so much.
Thank you so much, Joanne.
Thank you, Debbie.
So nice to see you.